Sir, it's an honor, truly, to kind of interact with you. And we really appreciate you taking time out, sir. We've been visiting to your office pre-COVID. It was always nice and a warm reception from Ramaswamy, sir. Trying to take us through the journey on the CV space and some bit of Sundaram Finance. And that's what has kept us hooked onto the finance, to your business model. I mean, what we have always looked at is, let's look more at business model rather than the financial model. Because if we have everything right in terms of business model, the numbers will flow through. And your is a testament to what we have seen through. If we just get things right, there is no reason that despite CV cycle, you would still do the required return ratios which investors on the street look at. So what we did was, we used to cover Sundaram Finance in Centrum Capital, where I was part of there. I was part of an analyst. We recently moved to Monarch Net Worth. We started the institutional equities desk, and then Pooja joined in. And she's the one who initiated coverage on Sundaram Finance. Again, Ramaswamy sir was instrumental, we would say, in helping us understand nuances. And we've been hearing a lot about you and sir Raju sir. When I spoke with some of our clients, they did make a mention that whenever they are in Chennai, you would have taken your time out to meet them. So we just thought if we could connect all the dots, see if there is any way we can strengthen the relationship and maybe act as a bridge in terms of connecting you with the investors. And that was the idea where all of this originated. Yet again, I really thank you, sir, for considering our request. We have a long list of investors who are keen to hear you. And it ranges right from CIO level and CIO at senior funds to analyst in funds. And we also have some of the private equity clients who are looking to join in and hear you today. Mr. Kaushik Narayan, the session after this one, he's based out of Chennai itself. He works with, he runs an organization called Leap Trucks. So even when we mentioned that we have Rajiv Lochan sir and the entire management team, even he was excited and he said that we would want to be part of the session. We said, yeah, happy to kind of go through. So, sir, remember, we are at 10 here. We've kind of broadly discussed on how we want to take this discussion forward. We'll limit this to 50 minutes. We are at 10. Can we kind of open the window? I mean, we have put everyone in the waiting room. Can we kind of start admitting people?
Yeah, please do. I just want to thank you for your kind words and also, more importantly, for thinking of us and giving us this opportunity. So thanks a lot for that.
No, sir, that's genuinely.
It's an honor for us.
Good morning.
So genuinely,
good morning,
it's from the heart. Hi, good morning,
gentlemen. This is Dipankar here. We spoke yesterday.
Yeah, hi.
In fact, face to face, we are meeting all three of you for the first time. I've had a lot of conversations with Mr. Ramaswamy earlier, but we have not met face to face. And of course, with you, we haven't met before. So thanks for gracing this occasion, and sure you'll find it very useful. It's going to be a short interaction, but it'll definitely be very useful. So I think, Alok, you're dually, I mean, you're seen on two screens. So I think you'll have to, that is one. And secondly, I think you will now start admitting people from the waiting room.
Yeah.
So we have the participants. Should we start the call?
Actually, more would join in as time progresses in the next few minutes, but we can begin actually.
Okay. So would you like us to talk, Pooja?
So I'll just start with the brief remarks and then I'll hand it over to you, sir.
Okay.
So good morning, everyone. Welcome to Monarch Net Worth Capital's Fast Track Commercial Vehicle Day. In the first session, we are hosting Sundaram Finance Limited, which is represented by the Managing Director, Mr. Rajiv Lochan, Deputy MD, Mr. A.N. Raju, and the CFO, Mr. M. Ramaswamy. We would start this session with the opening remarks from the management and then proceed with the Q&A session. Kindly note that the participant's line will be on mute mode. Post management remarks, if anyone wants to ask a question, you can press the raise hand button. You can also post your questions in the chat box. This session would be of around 50 minutes as we have 2 more sessions lined up. So I will now hand over to Rajiv sir for his opening remarks. Over to you, sir.
Good morning to all of you. First of all, I'd like to thank Monarch Network Capital for thinking of us and giving us this wonderful opportunity on the CV Industry Day. Very grateful for that. As Pooja mentioned, I'm joined by my colleagues, Mr. Raju and Mr. Ramaswamy, both of who are veterans of the company and have frankly built the company. I am relatively new to the organization, but feeling very, very much like being part of a family that I've grown up in. And very glad to participate in today's event. What we've been asked to do is spend maybe 10-15 minutes upfront offering some remarks on the industry, which I will do. And then we look forward to any questions or any comments that all of you might have. And it will be a good opportunity for us to exchange views and perhaps learn from each other. What I thought I would do is structure my remarks at least in 3 parts. First, do a look back on the CV industry, which I'll keep somewhat brief. And then we'll sort of look ahead to share our perspective on how we see the sector playing out, what some of the underlying dynamics are. And then I'll just save a couple of minutes at the end to talk a little bit about our own approach and plans and so forth. So that's how I thought I'd structure these remarks. I'll try and keep it to 10 to 15 minutes as requested. As all of you are aware, the commercial vehicle industry has been through a fairly tough time. I think COVID has only been the last challenge in what has been a series of challenges over the last 3 or 4 years. Pretty much right after GST implementation, in many ways, things have been somewhat rocky. I think the axle load norms that were introduced, the transition to BS6, the liquidity crisis that we witnessed in 2018-19, which then caused financing to the sector to get a little bit more challenged. And of course, lastly, COVID now. So it's been a series of almost mutually reinforcing negative impact to the sector. And that down cycle has therefore been quite sharp over the last 3 or 4 years. And as a consequence, essentially what has happened now is there's a bunch of excess capacity that has been created. And demand, therefore, has also been impacted on the demand side. So the combination of excess supply and lower demand has obviously skewed the economics of the sector. From a peak of about, 350,000 units in 2018-19 that we saw, we closed this past year at maybe, 120,000, 130,000 units, 140,000 units, somewhere in that range, almost a third of what we saw at the peak. And, the run rate in the first half of this year has somewhat maintained at these levels, right? And in many ways, we were expecting right about now for the recovery to pick up and the upcycle to begin. I think what COVID has done is in many ways sort of pushed that out perhaps a quarter or two. And of course, the commercial vehicle industry's fortunes are very much tied to sort of the economic activity more broadly. And as that economic activity picks up, it is likely that the commercial vehicle demand will also pick up. I think the most important set of trends over the last 2 or 3 years have been sort of an increase in overall tonnage on a unit basis. So, we're seeing now units at 30 tons, 40 tons, 50 tons, and so forth, and that tonnage has moved up. We're also seeing newer, smaller tonnage vehicles in the commercial vehicle space, which is, I think, an important and interesting trend, particularly for our customers. But more critically, I think over the last 6 to 12 months, viability of the commercial vehicle operator, particularly the small road transport operator who we tend to serve, their commercial viability has been quite depressed, primarily because of the excess supply and therefore depressed demand, that dynamic causing freight rates to remain, somewhat flat, if not even in some segments. Through the course of the pandemic, we've seen freight rates compress because there's been sort of irrational pricing that, given the excess supply, people were driving. And in parallel, we've also seen sort of the input costs move up quite substantially. Diesel is moved up quite sharply in the last 6 to 12 months, and that has put a strain on the viability of our customers and the commercial vehicle operator in general. So it's been a little bit of a tough period as I look back at the last 3 or 4 years. Looking ahead, as I mentioned, we were expecting that the second half of this fiscal would begin to see the upcycle commence. And going into our budget planning, for example, and this is true of all our OEM partners, as I look at my peers as well, I think there was a sense of optimism that this year would begin to see a sharp uptick in the overall commercial vehicle industry's fortunes. And we certainly sort of did our budget planning with a sense of optimism, given that we felt that a low was reached or nearing being reached, and that we were starting an upcycle. I think the wave two was quite a sharp blow across the sector and the industry, partly because it was, the intensity and fury was quite immense, but also the economic and emotional sort of trauma that it has caused has been quite deep-rooted. The community that we serve in particular has been impacted because these kind of healthcare expenses, the kind of loss to the principal operators and their family members is actually quite debilitating for this segment. And so the fortunes of the commercial vehicle operator segment have been further sort of exacerbated, I would say, through wave two. As I look ahead, it's probably worth looking at the broader commercial vehicle industry in sort of three slivers: medium and heavy commercial vehicles, intermediate commercial vehicles, and light and small commercial vehicles. Traditionally, we've seen those three segments having different dynamics, and at least the second segment, the ICV, is one that is emerging quite with some interesting dynamics, so it's worth looking at those. If I look at the MNHCV in particular, the bulk of the pain that I described has probably been felt by that segment the most, and operators in that segment have probably felt the most pain, particularly through the COVID period of the last 6 to 12 months. And within the MNHCV segment, I would say it's particularly the small road transport operator and the market load operators who've been impacted quite a bit. The dynamics around the supply demand I've already mentioned. I think that was quite severe in this segment. We've not seen any substantial freight rate increases given the input cost hikes that we've seen. And more importantly, for the MNHCV operators in this segment, I think the cash flows have also been jammed, whether it is from their end customers, corporates, contractors, even governments, I would say. I think what COVID has done is put a little bit of a greater tightening, if you will, of cash flow and cash flow management. And so this segment has particularly faced a fair bit of tightness, if you will, although liquidity has been aplenty and the measures that the government and the RBI have announced have been quite helpful. The fact that cash has not come through on a timely basis has created a fair bit of pressure. And that, when you combine with the input costs going up, diesel and the cess sort of moving up quite a bit, viability actually gets jammed quite substantially. And that's one of the primary sources of stress for a lot of these operators. I think they've grown up in this business and this is the primary thing that they know to do. And it's not like a conglomerate. They have diversified streams that allows them to manage the risk. So for a lot of them, their livelihoods have been quite deeply impacted. And as we look ahead, this pain will continue for a little while. I would say particularly there are some subsegments that continue to remain quite deeply impacted, which are primarily COVID related. So for example, if I look at the tourism sector, a number of the bus operators that play in the tourism space, interstate buses, tourism related buses, tempo traveler operators are in deep stress and continue to remain stressed. Likewise, the education sector, where operators of school buses and college buses who've just not seen the education institutions open up for a 12-18 month period. Essentially, they've not been able to use their assets. Some through COVID, we've heard stray reports of repurposing of a school bus into an ambulance and things like that. But those were, very opportunistic, short-term kind of moves people made. But as I look back at the last 12, 18 months, it has been quite a bit of pain for the school bus operators and the college bus operators in particular. And of course, anyone related with the tourism segment more broadly has also gotten impacted, tourist taxis and such, although it's not directly MNHCV. But if I look at the pain, therefore, it's been quite substantial in some of these sectors. And market load operators associated with specific subsegments in different parts of the country have also been impacted. So, for example, cement industry is doing quite well in the north, but not so well in the south. And so some of the cement industry related transport operators, Andhra, Karnataka have faced quite a bit of strain. And so there are pockets of, for example, vegetable operators between southern Tamil Nadu and Kerala have been quite deeply impacted. So if I take a route by route and subsector by subsector focus within the market load operators, there have been operators that have faced fairly deep stress as well. So MNHCV, I would say, has borne the brunt of the last 2-3 years of a down cycle. We think we're probably at the worst, but it's very much contingent on economic activity sort of resuming and life sort of getting back to normal. So that's a little bit of comment on the MNHCV segment. On the ICV segment, we think is a very interesting development happening. We see a lot of the MCV and perhaps even some of the HCV customers, as the cost pressures and the viability pressures have increased. I think there is a movement downwards toward ICV. The 15-tonner, 16-tonner range is actually quite an interesting range. There have been a substantial amount of technological advances as well. Fuel efficiency is much better. We're seeing a much better maintenance cost. Drivability is a lot better. So we're seeing that trend beginning to happen. Equally, sort of the light commercial vehicle operators who are doing well are beginning to move up in tonnage and then beginning to occupy the ICV space. Of course, this is a trend actually we called, I'd say, about 3 years ago and began to make a push towards ICV. And right now we're seeing good traction in this segment. In our view, this segment will continue to remain quite robust and see traction, especially as I think about some of the other developments like the dedicated freight corridor and so forth, scrappage policy taking effect in the years to come. I see there are some interesting possibilities where ICV becomes sort of the last mile feeder of the dedicated freight corridor, giving fillip. And as people scrap their vehicles, they might consider this segment as an interesting one. So I think there are multiple dynamics that support the ICV segment getting more and more interesting from a customer standpoint. The third segment that I referred to was the light and small commercial vehicle segment. Very interestingly, that segment in many ways has not been impacted by many of the trends that I mentioned, especially related to the MNHCV segment. And if anything, I might even argue that it has benefited from COVID. The thrust towards e-commerce, digital commerce. We were even getting reports of migrant laborers moving back to their native places, now beginning to invest in a small commercial vehicle in those markets, right? So I think this segment, the SCV segment in particular, is one that has seen quite a bit of traction through the COVID period in particular. This is again a trend we called 3 years ago and have steadily built up our own muscle behind the SCV segment. And so we see this segment's fortunes continuing to remain pretty good as we look at the next few years out. And I think from the manufacturer side, as we talk to our OEM partners, there is a clear sustained investment from a supply side in this segment as well. So I think on the demand side, things are looking quite interesting, fueled by e-commerce, digital spending, and so forth. But equally on the supply side, I think there's been an investment in dealerships and production capacity, in technology and so forth, which allows for supply meeting that demand quite nicely. So I feel the LSAV segment, the light and small commercial vehicle segment, looks quite interesting as we look out. So that's a little bit of commentary on the three broad subsegments of the commercial vehicles. I'll just take 2 minutes. I'm sensitive to the clock. I probably have 3 more minutes. Let me just quickly touch upon some of the highlights from a Sundaram Finance perspective. MNHCV has been our bread and butter, and we've built a good reputation thanks largely to the loyalty of our customers in the segment. We are particularly proud of serving the small road transport operator, and I think connecting with them and in some sense helping them grow has been an important responsibility we think we've fulfilled over the past few years. And we will continue to stay focused on serving the needs of that underserved segment, which is in many ways the underpinning of the Indian economy in our view. We've gone through the down cycle. As I said, we called a lot of these trends a little bit ahead of time and have made some investments in diversification. I think there are two broad trends. One, which I already touched upon, which is the shift towards ICV and the LSCV that we already did. That was an important element of our diversification to counter the down cycle in MNHCV. Equally, I think we also have made investments, I'd say over the last 10 years, quite substantially in the tractor and farm equipment segment and in the material handling and construction equipment segments. Both those segments, interestingly, over the next few years are seeing significant change and significant almost policy disruption, right? The rural agri segment is witnessing, in my view, unprecedented policy change, a lot of which will hopefully come through an implementation over the next few years. But that's going to see dramatic transformation. And so we think our investments over the last few years in that space, the broader rural agri segment, provides lots of opportunities and runway for us to explore. Equally, the national infrastructure pipeline and related investments in infrastructure and construction, we think are quite material and substantial. 100 lakh crores is a remarkable amount of investment. And so there's going to be substantial traction over the next few years. And again, we see the investments we've made in that material handling construction equipment, backhoe loaders, excavators, pavers, and such. That segment actually beginning to build on the foundation we've laid. So we see that as a very interesting opportunity for us. And the third piece of diversification we've done is sort of the geographic diversification. Historically, we were very much a south-based player. Many people still perhaps see us as a south-based player. But 40% of our branch network, 40% of our business, 40% of our people are now in the western, northern, and eastern markets. And we've grown our footprint there quite nicely over the past few years. So we see that geographic diversification also quite an important set of investments we've made over the past few years. I do want to close with a note on COVID. COVID, particularly phase 2, has been especially trying for us and our people. We have prided ourselves in sort of providing a human touch and a personal connect with our customers. That's been our greatest source of strength and why we think our customers sort of reciprocate with loyalty and why our people come to work every day charged up. I think what phase 2 did was, of course, there was healthcare impact. Of course, there was economic impact at a company and a personal level. But to my mind, the bigger impact that we faced was the inability of our people to grieve and condole with our customers, right? Traditionally, we have celebrated the victories of our customers and we've mourned the tragedies of our customers in person. That's been the Sundaram experience and the Sundaram style, right? And we literally prevented our people from stepping out during wave 2 because we felt it was important to protect and take care of safety and health of our people rather than put them through risks. But that has been quite a trying experience for us. I think time heals. And I'd say the past 2 months we've healed as we've had the chance to go back and connect with our customers. But I think that emotional cost has been quite heavy on our people. And so as we look ahead, I'd say, our priorities remain serving our traditional customer segment with the diligence and focus that we've always served, which is essentially the small road transport operator, the underserved small operator in this segment. I think restoring our asset quality and to our traditional levels, we still remain best in class, but we're still far from where we traditionally have been and where we'd like to be. So getting that back and ensuring that we preserve our capital is an important priority. And as I mentioned, there are several growth opportunities ahead of us, and we will continue to rely on our time-tested trinity of growth, quality, and profitability, and we'll strive to strike that balance. But above all else, we just want to ensure that we deliver the Sundaram experience to each of our customers, big and small, in keeping with the ethos of Team Sundaram. So that's a little bit of commentary on what we've come through and where we are. I may have exceeded time by a couple of minutes. I seek your forgiveness, but I'm happy to now take questions. I have my colleagues, Mr. Raju and Mr. Ramswamy with me, and we'd be happy to offer a view on any areas that might be of interest to you.
Thank you so much, sir. That was very insightful. We already have some questions in the chat box, so I'll just start reading out. The first question is from Mr. Sham. He's asking, can you please comment on the fleet operator profitability? How are the large operator profitability compared to small operators profitability? And between market load segment and contractual load segment, how does the profitability vary?
I will give a broad view, but I'll request Mr. Raju to offer deeper insights. In general, I think the fortunes of larger players have been better compared to the smaller players. And this is a trend across, I would say, corporate India, not just this segment, right? I think post GST, what has happened is there has been a squeeze on the small and medium enterprise, more so at the small end of the enterprises across corporate India. In many ways, I think that is the design. We have 6.3 crore SMEs in the country, and for an economy of our size, we probably 3 times or 4 times as many. So we have a number of dwarves who are small and will never grow, whereas we actually need children who will grow quite rapidly. So that's in many ways a characterization of the challenges that corporate India has faced over the last 4-5 years, I would say, ever since GST has come in. I think that trend has very much played out in the segments that we operate in as well. I think the fortunes of the larger operators, fortunes within operators who've had free vehicles have been much better than those that haven't had that flexibility and freedom. And therefore, the small operator have certainly got squeezed. And as I mentioned, the viability has remained stressed, both as a result of freight rates remaining capped and the input costs going up, particularly diesel, which has hit the smaller folks quite substantially. And that has certainly placed a lot of strain. But let me request Mr. Raju to offer sort of his perspective as he sees trends across the country.
I think I will echo what Rajiv said. In addition, what has happened is also that the larger customers have registered with GST and they are filing GST returns. So they claim the credit for the GST input credit, which is not possibly available for a small operator unless he complies with the GST requirements. So that challenge, coupled with COVID, many of the smaller guys did not do. So to that extent, the sector has moved favorably towards the larger operators. On the contract versus non-contract, the contract provided, in many places, what we found is that the contract provided for adjustment after 30 days for a diesel price increase of, let's say, 2 rupees or 3 rupees. It was not calibrated at 50 paisa or 1 rupee, and the diesel price just moved. So the lag is one. Second thing is the credit period. Now this immediately put a squeeze on the working capital of the operator. Already he was squeezed on various other fronts. This elongated the working capital, the requirement, increased the requirement and elongated. Rajiv mentioned in his opening remarks that the working capital cycles have all elongated. And I think that's where corporate India, possibly in the contractor segment, when I say contractor, not the construction contractors, I'm talking of the contracted load, the freight contract, corporate India has delayed payments. So earlier it was 60 days, is now possibly some departments in corporate India got affected. So they were closed, the bills could not be processed, or the bills could not be submitted by the contractor, the freight operator, because his people were affected. So the elongation of the cycle has moved. Now we are seeing close to 120, 150 days. Both put together, working capital strain is also there. They're coming out of it as the bills are now getting submitted, processing has started. We are seeing improvement, but a long way to go.
Right. We have the next question from Mr. Antariksh. He's asking, does Sundaram, from a medium to long-term perspective, plan to make changes to the standalone business such that the core ROEs go up to mid or high teens? If yes, what? And what will the current run rate remain the target? Or will the current run rate remain the target?
Okay. I'm not sure how the gentleman is defining core ROE. The way we define core ROE is we net out investments in our subsidiaries and joint venture associate companies and then calculate ROE. That core ROE, if memory serves, Mr. Ramaswamy, correct me, is already at about 19.5% this past year that we closed. And I think for the previous year, it was about 16.5%. So our sense is the core ROE already on the current sort of set of operations that we are on, asset classes, geographies that we focus on, is already in the high teens. And, that's the current position. But if there's a misunderstanding I have on the core ROE, it will be worth getting that clarification.
Okay, he has another question. How has been the nature of restructuring offered? Is it a 1 to 2 year of EMI holiday, or is it lowering of EMI or extension of tenor? And based on how things are evolving, how much of the restructured customers can be expected to get back to business in the next 3 to 6 months?
Yeah, I can comment on the approach we've taken. Hard for me to comment on what others have done. I think for us, the approach has been very much to go customer by customer, sub-segment by sub-segment, geography by geography, and form a view at the customer level of the intention and the ability of the customer to revive their business, right? Not so much pay us back, right? I think we formed a view on what is going to happen to the underlying dynamics of that customer, given what COVID has impacted. So that's the context in which we approach restructuring. And as we did that, I think the primary objective for us was to, first of all, calibrate the intention of the customer. And second of all, calibrate the timeline for the ability of the customer to get back on their feet. And as I mentioned, I think sub-segment by sub-segment, these dynamics are slightly different. And as a consequence, the prescription of restructuring that at least we applied was tailored to every individual segment. So we have instances where we've given a 3-month sort of holiday on EMI and then softer EMIs for maybe another couple of months before they come back to the regular EMI. That certainly is there. There are some segments where we've given sort of a 6-month holiday before it picks back up. So it varies segment by segment. I think what for us certainly was a gating factor was the asset liability mismatch, because ours sadly is a depreciating asset. That's an underlying asset. And so we were quite sensitive to ensure that we are not extending the restructuring period too long. That puts a pressure both on the customer and us, right, in an unfair manner. So I think that allowed us to gate the approach we've taken to restructuring at an individual customer level. And I'd say there are some subsectors where we did, I think, call it wrong. I think we should be clear about that. So for example, in October, November last year, when we were doing the restructuring, we were expecting life to resume by April, May, June, right? And so, for example, in the education segment, we were expecting that schools will come back by the June academic year reopening. And of course, wave 2 caught us, the intensity and magnitude and fury with which it hit us caught us certainly by surprise. So, that's put a little bit of a complication for us to deal with. Mr. Raju, any other comments, Mr. Ramaswamy, from a...
Exactly the thing. Buses where, I think school buses is where we got it really wrong.
And so one more point is that when RBI, after this COVID-2 relief measures, when they announced restructuring for 2.0, rather, at that point of time, there was a notification in respect of restructuring of loans to individuals and small businesses. And there is another notification for some MSME customers. So in respect of the individuals and small businesses, where the customer had availed restructuring under the earlier plan of 2020, August 2020, and the tenor not got extended up to 24 months, which was permissible under the RBI circular, that the loan can be extended by another few months, depending on within the overall 24 months. But similar dispensation is not provided for MSME customers. So I think RBI, I think many of them are industry people are represented to the RBI, because many of the bus segment and school buses are also comes under MSME, and where the loans were not restructured up to 24 months in the last restructuring exercise of 2020, they are now got affected actually because of RBI not providing the support.
Okay. If anybody has a question, they can post in the chat box or can use a raise hand button.
So there's a question in the chat box here again from Mr. Kaushik Narayan. How has the collection efficiency been across regions? In the wave 2, are there any trends specifically to look at from Sundaram Finance point of view?
I think it's been a month-to-month a sort of learning and discovering experience over the last, I'd say, 12 months in particular, right? And I think the dynamics of post wave one are quite different than the dynamics of post wave two. In general, I think as economic activity has recovered, payments have gotten better, collections have gotten better. We saw that post wave, when the moratorium came to an end and life began post wave one, we saw that. We've certainly seen it in the last few months. June is better than May, July is better than June, and so on and so forth, right? And September is looking certainly better than August. So I think that's one important trend, which is that collections are tied very closely to underlying economic activity. I think the underlying dynamics of that we've discussed so far, whether it's in MNHCV or whether it's an SCV or large fleet operator versus small road transport operator, dependency on the cement industry, state government dependency in terms of payments, LPG cylinder operator. So there's we've got to look at the dynamics from a asset class as well as region standpoint, very much based on the granular build up of these trends. And certainly in markets of ours, which are more MNHCV dependent, which are more small road transport operator dependent, which are more, for example, cement industry or state government dependent, I think the stress has been a little bit more, completely understandable, given that these are, unprecedented times that we're going through. And other places where we've had, a slightly less reliance on some of these asset classes and customer segments, I think obviously life as it has come back has been much better. So, at a broad level, those are the trends we're seeing. Anything else, Mr. Raju, to note, or Mr. Ramaswamy, worth calling out?
But relatively, the COVID has affected in the month of May and June at the southern part, actually. Even Kerala is still under challenge because of that. But other than the south, when you look at it, all of them were affected only for a part period of either March or April. So all the other states outside the south, actually, all of them have recovered well in terms of the customer viability and also as the repayment, etc. is definitely better. But southern states were most affected, and the customers, though they are back into the business, but because unlike the COVID one where RBI allowed moratorium, this time there is no moratorium is allowed. So when the customers came into the business, their ability to catch up with the old arrears is becoming a challenge today. They are able to service one installment, but their economic viability is not enough to catch up with the past arrears. So that has been a challenge now at this point of time.
I think that's an important point on sentiment, which I just want to echo, right? I've been traveling up in Madhya Pradesh, Rajasthan, Delhi, Maharashtra, and so forth. And certainly the mood there is much, much better than what we see down here in the south. So I think there is a definite sentiment, and it's very much tied to the point Mr. Ramaswamy is making around, the mood which moratorium offered versus not having it now and the rollover happening. I think that is causing a little bit of sentimental hit now here in the south.
So as an extension there, is it safe to say that the northern markets or non-south markets could well enter into a pre-COVID collection efficiency sooner than later?
Yeah.
Are we already there?
I think that's a fair comment. Yeah.
So we are already there, or we should be there in a month or two's time?
Already there.
They are already there, I would say.
And for south, it should be a quarter away's time, or could it be Q3?
Yeah, probably. 1 quarter.
Sure, this was an extension.
Looks like.
Perfect. Yeah. Thank you, sir.
There's a raised hand, so I think you have to take.
Yeah, sir. We have a question from Mr. Prashant Sridhar. Sir, you can go ahead.
Yeah, morning, sir. Hope I'm audible.
Yes, you are, Prashant. Go ahead.
So I just wanted to check. So with this diversification in the vehicle finance industry, and you even have an HFC, what is sort of the strategy for Sundaram Finance, let's say 5 years down the line, in terms of what to grow and where to grow?
Yeah, 5 years is too long a period given the kind of uncertainty and volatility we are seeing, Prashant. So I don't know if I'd be, certainly I'm not wise enough, but I don't know if I'm courageous enough to take a 5-year view. But as I look at the unfolding macroeconomic opportunities in India, the next 5 years certainly presents, in my view, an unprecedented, growth and prosperity opportunity for the country. We've had, a number of investments in policy and changes in the approach and reforms that have been put in place over the last 4 or 5 years. I see them naturally playing out over the next few years. And as I correlate that with sort of the geographies we operate in, as well as the asset classes we are present in, I think there's a very interesting possibility for us to participate and support the growth of the sort of India prosperity journey, right? And so from that standpoint, to my mind, what we need to do is more of what we've been doing, try to do it, as much better as we can. We will stick to the growth, quality, profitability trinity that has worked very well for us and has been tested over the last few decades and works well. And there's plenty of headroom in geographies we operate in and asset classes we operate in that we can participate in the growth that will naturally come quite well. So to my mind, continuity and ensuring the Sundaram way is deeply embedded and scales up is the real strategy, I would say. Of course, there is a hell of a lot of investments we're making in technology, digital, data science. And what we see that doing is actually helping unleash the productivity and the Sundaram touch that our frontline teams can deliver to our customers. Roughly about a third of our people's time goes in administrative tasks, which we think can be nearly entirely eliminated through smart digital and technology interventions and support. And through data science, we think we can provide a lot more focus and prioritization to their efforts. And therefore, I see that set of investments that we've made over the last 5 to 10 years continuing over the next few years, and perhaps sort of industrializing that a little bit more so that we can genuinely scale up the unleashing of the Sundaram experience to all our customers.
Sorry, I was on mute. Fair point, sir. Just wanted to check on one more trend. So when we look at the transportation sector, over the last 1 year or so, there seems to be a lot of investments going into warehousing or setting up more localized warehouses, which sort of has an effect of making the transportation sector more formal, so to say. Right? So how does this affect the three broad segments that you categorized: MHCV, ICV, and LHCV?
Well, I think in general, particularly as the rural agri space, following some of these reforms that have been legislated but are awaiting implementation, in particular take effect. And the trend that you're referring to is, I think, more broad-based than simply rural agri. But I think, if I took rural agri as an example, it's genuinely going to be transformational in terms of the supply chains there. I think we're going to move away from gunny bags to bulk storage, with contract farming becoming available, with procurement being much more broad-based than simply at the mandis and the APMCs. I think there's going to be a lot more interesting competition that will break the monopsony that we've been shackled by over the past several decades, I would say. And so that obviously creates plenty of opportunities for logistics and transportation. And it's not going to be just restricted to localized, origin destinations, right? We could actually see a significant change in the way we think about underlying goods being transported pan-India, and that opens up new routes. Parallelly, we are seeing infrastructure developing as well, which means our road network is going to be better, port to road is going to be better, rail to road is going to be better. So, as that infrastructure story unfolds as well, there is going to be a significant boost to the transportation sector as a whole. Now, I think the interesting challenge is going to be to figure out, which of these asset class subsegments and which geographies and industry subsectors are where the action is going to emerge sooner rather than later, right? I think that's the trick. And at least in our view, the best way to do that is to stay close to the ground, understand how our customers are behaving, stay in touch with our OEM and dealer partners, and really get a pulse for these trends a little bit earlier than might happen otherwise. In general, given our customer intimacy, that has been our experience so far, right? We've had the good fortune of being able to call some of these trends a little bit ahead of time. And we're hoping that same approach will stand us in good stead. Ms. Raju, any additional comments from your end?
Yeah, this is nothing.
Okay.
Sure, that's it from my side. Thank you so much, sir. You've been pretty helpful.
Thank you. Sir, we have some more questions in the chat box. Sneha has a question. Any change in borrowing mix and your outlook on cost of funds and margin front?
I would request Mr. Ramaswamy to answer the question. I'll just give a short preamble that we've been very blessed to have, very, very good access to funds. Largely, I think because of, the reputation we have and the tradition that we've adhered to. But equally, I think Mr. Ramaswamy and his team do an outstanding job in maintaining the relationships with our lenders and ensuring that we get, a fair pricing for what we do. But I request him to offer his comments.
Yeah, with so much of liquidity is there in the market, as well as the flight to safety, that the expectation of the investors, a company like us, Sundaram Finance like us, were able to borrow at a finer rate in the market the last 1.5 years. That has always been, but the last 1.5 years is really very attractive to borrow. But unfortunately, there is not much of a growth in the asset side. It is only replacing the maturing liabilities, what is happening here. So that is in a way benefiting the company, because if you look at it compared to 1.5 years before and today, definitely our cost of borrowing is minimum about 2% lower across the different tenure of borrowing, whatever we do it. But on the lending side, when you look at the asset side, when you look at it, see, the commercial vehicle market is the most aggressive in terms of the pricing, which is not growing because there is a slump in the market and the demand is not there. So at the moment, we are able to have a better spread in terms of incremental business, what we are doing it. But the moment MNC cycle come back automatically, and also as well as that, there is some sort of even among the competition also. Okay, competition, the higher end of in respect of fleet operators and etc. The competition is so tough the last 6 months. But if you talk about it prior to November, when you talk about it, November 20, I think many of the lenders are also cautious whether to take risk or not. But the last 6 months, when I look at it, definitely they are aggressive on the fleet operators' point of it. Small and medium operators, still we have not seen of much of tough competition, which used to be the case in the normal circumstances. I think going forward, when the CV industry revival start happening, there will be a normal reduction in the lending rate will also happen. But by the time when we see growth in the economy, RBI also will probably put up the rate also. That's what we believe in that. At the moment, it's a good time to borrow.
And the only sort of material change in our source of funds has been that the securitization market has been somewhat low in the last 12-18 months, and that's just a natural consequence to the dynamics in the market. We see that sort of coming back up as things sort of normalize a little bit and we get back.
And second thing, we are not borrowing much on the shorter end, because when the rates are quite attractive on a medium-term borrowing, we slightly increase our penetration on the medium-term in CDs and other things. That's the way what we are doing.
Right. So we have the next question from Mr. Lakshmi Narayan. Sorry. So we have the next question from Mr. Anand Bhavnani. He's asking, given the weak growth and the high competitive intensity, how much do you expect margins to contract as interest costs normalize?
Can you repeat the question, please? Given the
weak growth and high competitive intensity, how much do you expect margins to contract as interest costs normalize?
Yeah, no, so again, the weak demand is concentrated in specific asset classes, and competitive intensity, therefore, also is in specific asset classes. And so it's hard to sort of generalize and say that there is significant margin pressure. in specific asset classes, we will see margin pressure. So, for example, large fleet operators in the MNHCV segment, there is obviously not so much demand, but there's plenty of supply, and there's significant margin pressure. But if I look at, for example, tractor and farm equipment, that segment is growing quite nicely year on year. Over the last 2 years, we've seen sort of nice double-digit growth, where demand is there, supply is in some ways the constraint, and so margin pressure isn't as much. And as Mr. Ramaswamy said, our cost of funds are at the lowest that we've seen in a while, right? And that gives us meaningful comfort and cushion on the spread that we're able to make. So I think as I reiterate the diversification we've done, both in terms of asset classes as well as geographies, that gives us meaningful base around which we can optimize the IRRs and yields we're able to charge, and at the same time, given the cost of funds advantage, strike the right balance. So market, we want to pick up share, we are aggressive and pick up share in specific markets, specific asset classes, specific customers, I would say, where there's a strategic need for us to place a bet. And so we are going head to head with some of the larger private sector banks in many of these markets. Equally, we have many other segments where we have a strong presence, great customer connect, and the ability for us to realize the appropriate pricing works out okay. So overall, I would say we are holding up well. And so Ramaswamy says, looking ahead, as rates firm up a little bit, and sort of the credit deposit sort of ratios for banks in particular begin to pick up, we will enter a period where things will get challenging. But that's, I think, part of the game, right? We just have to deal with that, and that's where I feel our both diversification approach that we've taken, but also this time-tested growth, quality, profitability balance that we've learned to strike will help us.
Right. So he has another question. With the dedicated freight corridor likely to get completed in about 12 to 18 months, which can further impact the MHCV demand, when do you expect the MHCV vehicle sales to cross their previous financial year high?
If we knew the answer to that question, we'd be in the wrong business, right? But with that said, I think there are multiple dynamics that the dedicated freight corridor unleashes, right? On the one hand, obviously, in the corridors that they operate, look at the northwest and the northeast corridors, the dynamics are slightly different. Underlying sectors that they serve are quite different. There's also, I think, roll-on, roll-off type arrangements that we will begin to see happening, which actually then, protects the demand for road transport. Plus, the rigidity of rail transportation means the feeder routes open up to transport goods at the last mile. So that creates additional opportunities. So to my mind, if I look at the broader set of shifts that are happening, and sort of some are offsetting, some are actually reinforcing, and therefore right now at least our view is we just have to go sector by sector, geography by geography, and form a view on which asset class will have benefits and which asset class may face some headwinds, and accordingly tailor our approach there. Overall, I feel as economic activity picks up, the transportation sector's prospects also automatically pick up, because it is very much in many ways the driver of economic growth and prosperity. And so from that standpoint, it's just a matter of figuring out where we press the accelerator and where we sort of have to step on the brakes a little bit. I mean, that's very similar to what you guys do, right? As investors, you have your eggs in multiple baskets and you know where you double down and where you pull back, right? It's exactly the same approach in many ways, right?
Right, sir. So we have a question from Mr. Umang Shah. Sir, I request you to ask only one question because we have some more questions lined up in the chat box and we are short of time.
Yeah, sure. Thanks for taking my question. I just had one question anyways. Sir, if you could just touch upon the used vehicle segment, right, and give some color in terms of demand dynamics and asset quality behavior, how different it is from the new category, and some color on within that between passenger and commercial would be appreciated. Thanks.
And if I'll offer some views, and I'll request Mr. Raju to also offer his inputs. I think the used segment has obviously grown now in size and scale, right? As each of the underlying asset classes have matured, just the sheer stock of used vehicles is quite substantial. And that itself bodes quite well for the opportunities in that segment. The there's within used, there's a chance to work with existing customers that as they upgrade their fleets and as they dispose of or buy their vehicles, there's a chance to finance that. That's to our mind a very interesting segment, particularly from a Sundaram Finance standpoint, because it's a known credit and a known customer. And then there is a broader opportunity where there are newer customers coming in and tapping the used opportunity. The dynamics between, I will not spend too much time on the passenger cars. That's almost an ongoing sort of cycle of replacement and new purchase. But on the commercial vehicle side, I think as technology has improved, the lifespan of vehicles has also improved. There are, of course, different players that operate at different vintages of used vehicles. Our preference has always been to work at the lower end, 5, 7, maybe at the most 10 years. We never go beyond that, but there are peers of ours who operate much beyond that as well. That, I think, remains an important segment, especially as some of the dynamics we spoke earlier about the small road transport operator getting squeezed on the MNHCV front for the variety of dynamics, which I won't repeat. As they transition to ICVs, some of them also transition to the used vehicle segment. It's a very natural place to go. There is supply. They understand the business and the asset well. It's a natural place for them to go. So that's a very interesting segment and opportunity as well. Last point I'll make before I turn to Mr. Raju is the scrappage policy. I think the scrappage policy creates, again, positive impact for used vehicles, but also creates a little bit of a gray cloud as far as used vehicles are concerned. I think the intent is to ensure that the useful life of the vehicle is maintained and we don't overuse, abuse the vehicle and cause complications. So to the extent that the scrappage policy has been introduced and there are pressures on the new vehicles, I think there is a window now where supply demand dynamics will again potentially increase the pricing, for example, of used vehicles and make it interesting from a window of opportunity standpoint. Equally, as the scrappage policy takes firmer root, incentive, disincentives, timelines get clarified and implemented over the next few years, naturally the ability for operators to push the used vehicles for longer and participate comes down, which is positive news on the new vehicle front, perhaps not so much on the used vehicle front. Mr. Raju, your thoughts?
On the used vehicle, two things. One is the new vehicle prices have moved up substantially, and the steel input costs have also gone up substantially. So between the two, our expectation was that the used vehicle prices will also move up. We saw that happening between, let's say, February, March, is when we saw that, and we thought that will get sustained, but it hasn't. Possibly because financiers are now repossessing vehicles and that park is coming into the system. So the expected increase in used vehicle prices has not happened. So just wondering why that is not happening, I don't have an answer.
Got it. Thank you. Thank you, sir.
So we can take one last question due to paucity of time. So what are the top three? I have a question in the chat box. What are the top three strategic priorities for the company when the situation normalizes? And how the next 10 years are going to be versus the last 10 years?
That's two questions rolled into one, but we will do the best we can in the time that we have. I think in terms of the top three priorities, as I mentioned, I think the highest priority right now is to ensure that our customers are nursed back and resume lives normally. That's clearly the highest priority because I think we exist because our customers prosper. If customers are in trouble, we think we are in trouble. And so the topmost priority is to ensure that they nurse back and are back to genuinely prospering as opposed to just surviving, which is what they're doing right now. Second, a priority is to maintain that growth, quality, profitability trinity that I mentioned has worked quite well for us. The balance across those three, quarter to quarter, year to year, will change over the next few years as opportunities and stresses become a little bit more apparent. But that trinity has worked quite well in ensuring that we are consistent, we stay in the market, we serve our customers, support our partners, and therefore deliver value to our shareholders over a long period of time. And so I think the second priority is to ensure that happens well. Within the sort of growth, I think there are 2 or 3 underlying trends, as we've already discussed. As the M&HCV segment comes back up, we see ourselves participating quite smartly in that segment. That, as I mentioned, is our bread and butter. As I mentioned, the whole, the light and small commercial vehicles is like a secular growth story over the next few years. We see that as an important one that we will participate in. Rural agri, the tractor and farm equipment and associated opportunities that open up in that geography, I think we will participate. And material handling, construction equipment, the whole infrastructure story, we see participating quite well. So those would be the contours around which our growth will get driven. Of course, subject to the balance between quality and profitability. We never have, and we will not chase growth for the sake of growth. We will ensure that the balance between the GQP is maintained. And lastly, I would say, in terms of delivering the Sundaram experience in a world where increasingly we are becoming distant, remote, virtual, digital, I think the human touch, we think, continues to remain quite important. And so we will, take the advantages of technology and data to power the human touch that underpins the Sundaram experience. I think that is a very important priority that we will drive. I don't think we will ever shy away from the human touch and the personal touch that our team Sundaram delivers to our customers. That will remain the way it has been over the last 10 years. For the next 10, 20, 30 years, I would expect and pray for.
Sure, sir. Sir, we are already out of time. So participants, those questions which were unanswered, we'll take them later with the management. Sir, do you have any closing remarks?
No, I just want to reiterate our sincere thanks to all of you. First of all, to Monarch Network Capital for facilitating this dialogue, and to all the participants for your patient listening to us. And those that we've not been able to answer questions, our apologies. We will find a way to connect and perhaps on a different platform address some of your questions. But thank you so much for the opportunity, and look forward to interacting more in the future.
Thank you.
Thank you so much, sir, for giving us this opportunity to host you all. We'll end this session. Thank you.
Thank you so much, sir.
Thanks a lot. Thank you.
Thank you, sir.